Welcome back to the Lance Roberts Show podcast right here at realinvestmentadvice.com. And make sure you subscribe to our YouTube channel, The Lance Roberts Show, so you can get automatically updated to all of our interviews and podcasts that we put out on a daily basis to help you manage your money better. Kevin, just for the break, we were talking a little bit about the slowdown in global manufacturing. And, one of the things over the last couple of quarters in particular, and this is really started in December of 2017, when the current administration passed a corporate tax cut. Mm-hmm. And this, of course, lowered the corporate tax rate to 21%, and this provided a huge bottom line boost to earnings, as simply, it doesn't mean I manufacture more revenue, it just means that I get to keep more of my money at the bottom line. Right. And what we've seen here is a huge extrapolation of earnings growth for the markets going over into 2019. Mm-hmm. Now, as you take a look at this, though, what we're already seeing, and I track this on a monthly basis, is that estimates for 2019 have already declined by $10 a share. And we're likely going to see more of that occur as the realization of trade wars and tariffs and these type of issues are starting to impact corporate profits. We're seeing more of that in third quarter earnings reports, more concern about the strong dollar, more concern about rising interest rates. We're seeing that kind of push down on these forward estimates. But that also, the problem with that is that a lot of the views of the market is like, well, stocks are cheap today because of forward estimates. Right. But if those forward estimates fall, then we're not really reducing the current overvaluation of the market, right?
Yeah, I think estimates are too high. They've been coming down. I think because of the global slowdown, they'll come down even further. And we're seeing more talk in these earnings calls that things are going to be a little tougher going forward. But estimates for the S&P next year are 160, right, which puts the forward multiple at 17, which seems reasonable enough, and it is, and unless it's not 160.
Right.
So, I think earnings, have gotten a little bit ahead of themselves here. The year-over-year comps are certainly going to be more difficult. Right. So I don't see the dollar reversing at this point, based on the current environment, and that again, really ties into the foreign part of these companies.
Well, it's interesting. I just did a study the other day looking at corporate profits. Now, this is just the NEPA corporate profits, and this is corporate profits before tax, any inventory adjustment, etc. Now, corporate profits before tax are at the same level as they were in 2012. So despite all these tax cuts, et cetera, what we're not seeing is we're not seeing a growth in real revenue on the upside. And this is representative of the fact that we are having this slower economic environment globally. Revenues to companies overseas are stagnating because, again, 40% of corporate profits coming in from overseas transactions. But after you apply the tax cut, we do have record corporate profits. Mm-hmm. So again, it's that almost that illusion of strength that we're getting from these one-off scenarios. The interesting thing is that as we move into 2019, we immediately start again to compare earnings on a year-over-year basis. So instead of seeing 20% earnings growth, we're seeing 3% earnings growth on a year-over-year basis because everything reverts back to basically longer-term economic trends. And is this going to be a valuation issue for a lot of the hopes that we're going to get a continue running bull market at this point?
Yeah, it is, because stocks and bonds compete for investors' cash.
Right.
And before, the acronym was TINA. There is no alternative to stocks because yields are in the dirt.
Right.
Now the 2-year treasury is just under 3%, and corporate bond yields have really started to go up as well. So now that looks a little bit more attractive. So money that had kind of herded into stocks, sometimes for the wrong reasons, right, now can go back to where it probably should have been in the first place.
Well, it's interesting you bring that up too, because when you talk about there is no alternative, which was the belief for the last decade, we had a lot of crowding into traditionally defensive sectors, right? We had a lot of people chasing, staples and healthcare and utilities for the dividend yield, because they were chasing the dividend yield because yield on money markets was essentially zero. All of a sudden, you've got a 2-year government guaranteed treasury with a higher yield than that of the dividend on the S&P 500. One of the things is that when we start talking about the potential for recession, is that and we're seeing this a bit here just lately, is that staples, utilities, et cetera, have been outperforming the previous leaders, right? The FANG stocks, technology, discretionary. We've seen some rotation to the safety, But if you take a look at valuations in a lot of these sectors, because of this run up, this chase for yield that's occurred over the last decade, a lot of these companies are carrying very, very high multiples that they don't historically. So the question is have we created, kind of like in the late 70s, in 1974, the Nifty 50, where you think is safe is basically now the fire. You've moved into an area that's believed to be safe, but it's as overvalued as the rest of the market. And do we see a potential issue there for investors?
Yeah, so this is going to get tricky here because we've seen the FANG stocks roll over.
Right.
The key that I was looking for is there another cyclical sector to pick up the slack, to keep the pro-growth economic expectation in place? Right. And we're seeing that they're all rolling over.
Right.
I track 16 different cyclical industries, and on a kind of long momentum model, 0 are in an uptrend.
Wow.
So we're seeing now a rotation, like we're seeing a rotation in the credit markets, now a rotation to these, albeit some are overvalued defensive companies.
Right.
But there's a rotation to the less risky type of companies, and valuation is an issue. So I think people in these traditional 60-40 portfolios that expect safety from the bond side are disappointed, and a rotation to high dividend yield stocks, which typically do better,
they're disappointed.
May not quite be the same as well.
Exactly.
Yeah.
And that's an interesting byline. We were talking about this in a recent interview with Kevin Smith, that when you take a look across asset classes, over 80% of asset classes have a negative rate of return. There's not been a real safe place to hide, other than cash, in this environment. And when we start looking at this, it's interesting as we talk about this market this year, which has had 2 major kind of drags. The one thing you would expect to see pick up here is the VIX, right? The volatility index. It has an average of about 20 over time. We got all the way up to 25. But you would have expected to see that somewhere between 30, 40, maybe even 50 with as much price volatility as we've had in the market. Gold really hasn't moved up at all, the traditional safe haven bet. And as you said earlier, interest rates, you would normally expect to see money rotate into treasuries as a safety trade coming out of risk of equities, particularly when you have 2 declines like we've had, but yet interest rates remain hung up here as well at around 3.1, 3.2%. So, we're not seeing investors really panic about this market just yet, even though it's picked up in volatility. You think they're missing something?
I think there's a lot of comfort with all the passive investing that's been going on. So it's like, well, I just own the market. So they think they're taking less risk because they're in these passive indexes, as opposed to an active manager, which has a wider variance potentially of returns.
Right.
So they're not in the mode of, that's not working, sell, let's do something else. It's like, I'm diversified as passive. I don't have to worry about the manager risk aspect to it.
Which is interesting because passive is always good until they start selling.
Yeah.
Well, and that's the thing is that despite this is that while individuals want to believe they're passive, we are all active in a different form, and it's just a function of how much money you lose before you become active.
Yeah. As I remember in 1999, that report came out that the top 10 stocks in the S&P 500 accounted for 105% of the return.
Yeah. There you go.
If that's not a here's your top sign, And just this year we saw the FANG stocks really do the same thing. There was a point, I think in mid-September, where the S&P 500 was up 9%.
Right.
If you took out the 6 FANG stocks, including Microsoft, the S&P was only up 3%.
Right. Yeah,
and so every dollar that was going into the S&P 500 kept disproportionately buying more of those top stocks.
Right. And of course, that's part of that is back to your point about the passive ETFs, because those ETFs all own the same top FANG stocks. I mean, and there's a lot of these ETFs that aren't necessarily technology focused or mega cap focused, still own the FANG stocks because that's what was performing. So a lot of the overlap there becomes a potential risk down here down the road. Kevin, thank you so much for your time today. We appreciate it. Kevin Lenox, CFA. He is the Senior Wealth Manager for United Capital, spending some time today talking about markets, and of course your money. If you have any questions, get by our website at realinvestmentadvice.com. If you have a question for Kevin, just simply send us an email, click the Ask a Question button. Kevin will be happy to answer it for you. And of course, as always, get all of our videos, podcasts, and more at the website, realinvestmentadvice.com, or on our YouTube channel, The Lance Roberts Show. And we'll see you next time on the next edition of the Lance Roberts Show podcast right here at realinvestmentadvice.com.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.
It's a rich man's world.